Investors, what do we want the most? Profits or making money, right? Of course, that's important. But there is one more thing which is even more important, and that is making money in any market scenario. Sometimes you may succeed, and sometimes, well, market takes over like it has now. In the past few months, I have made videos on my high conviction stocks. Some of them still remain as strong as ever, doesn't matter the market condition. But for some, I have just become muted, and I know that I'll be holding some for a very long time or for years before seeing any returns. So in these market conditions, it makes sense for opportunities that provides us as a hedge. And in today's video, I'll share an ETF that will work as a hedge in these market conditions. Now, why ETF? For me, it comes down to ease of use. I'm not investing any more time than the initial research and my money, of course. So picking stocks or companies or earnings, it takes too much of your time. And before we know it, it's taking majority of our day, and not all of us have that kind of time. So let me share this screen and start this video. Now there is one thing you need to know to fully understand this video, and that is BETA or beta, basically a stock measuring tool that measures the volatility of a stock. So if a stock moves less than the market, the stock's beta is less than 1.0. High beta stocks are supposed to be riskier but provides high return potential. Low beta stocks pose less risk but also low returns. So let me share my screen and kind of quickly go over the beta part. Okay, so beta is a measurement or a measure of volatility of a security or portfolio compared to the market as a whole. So what it means is that if the market goes up, let's say by $1, does the beta go up by $1 as well? Or sorry, does the security go up by the dollar as well? Or if the market goes up by $1, does the security goes up higher or lower? To kind of give you a quick comparison right here, this is Tesla. Okay, and this is Microsoft. And this is, by the way, a sheet or a investment or beta tracker that we made for our Discord. I have shared it with our members here. So if you would like to take advantage of this kind of stuff, then join our Discord and Patreon. Links are in the description below. So this is right here, two charts. So what you do is you just put the chart right here on B4, the cell B4, and it gives you the stock price, the change, the beta, the 12-month, and of course some of the high, low, and those kind of things, the volume. It's kind of put all those things in track so you can track side by side. So as you can see, this is Tesla, this is Microsoft. Pay attention to this number here. This is Tesla's beta, which is close to about 2.0. And this is beta of Microsoft, which is 0.86. That means if the market moves up 1 point, Tesla will move up 2 points. If the market moves up 1 point, Microsoft will move up 0.86 cents. Just in a very, very simple term. This is what beta means, that how volatile the stock is given the market. So now we understand the difference between the high beta or the low beta. High beta has a high return, as we have seen in Tesla, depending if the company is really good, and of course they have good product and service that people want. Now the low beta stock, which is Microsoft, for example, and Apple is another example. Apple is actually now above 1.2 or something, which is really interesting. But Microsoft, for example, it's a low beta stock. That means the price is not going to move much with the market, like not at the same degree. But of course, it's a much safer investment. But the return is also muted because of that. So now we are done with the boring part. Let's get to the juicy part, and why am I looking at this ETF, and why is this ETF so interesting? So here are a few reasons right here. So the ETF that we are talking about, the short form of that ETF is BATL right here. Oh, sorry, BTAL, as you can see over here. This is the name of the ETF. And this ETF provides exposure to the spread return between the low and high beta stocks. So this ETF plays both. It's very interesting. Watch this. Potential to generate positive return regardless of the direction of the general market. So it doesn't matter where the market is going, the ETF is going to generate positive return. So long as low beta, which is really, really important, stocks outperform the high beta stocks. So as long as low beta stocks are outperforming the high beta stock, the ETF is going to have a positive return regardless of the market direction. Provides consistent exposure to anti-beta factor by investing in underlying index, which reconstitutes and rebalances monthly in equal dollar amounts, which is of course very interesting, into different industries or different sectors, which we are going to go over in just a few seconds. Maybe an effective alternative of buying treasuries, volatile product, and low volatility funds if seeking to reduce overall portfolio risk. So this is not your investment, this is a hedge for your investment. And let me explain why. So at any given point, If a fund gives me this kind of return, I will generally stay away from it. Take a look. In last 1 month, the fund has given 7.44% return. In last 1 month, I would gladly take this compared to what my portfolio has seen in last 1 month, right? It's a bloodbath. What we have seen is like really, really bad. In the last 3 months, this fund has returned 13.17%. Again, a very good return for a fund which has basically both type of stocks. And I'll go over the industries in 1 second. Year to date, 6.36%. Still a decent return, nothing like S&P. S&P did like 27%. This returned 6.36%. Look at 1 year, 3.42 negative. Look at 3 year, negative 3.26, and 5 year is 0.39%. So this is clearly not a fund that you hold for a year or 3 years or 2 years. We can see this. But this is a fund that you hold in volatile times and when market has lost the sense of direction, which looks like it has now. So I feel in these times, this kind of fund could be really, really good as a hedge. Okay, so now take a look at some of the industries that this fund holds. Software, 308% exposure right here as of 6/30/2021. In the real estate right here, 216%. Retail, biotech, commercial, insurance, food, electric. So this means that in the same industry, like for example in software industry, it will have a mix of both high beta and low beta stock. And what it does is the high beta stocks, it shorts them. And for the low beta stocks, it just holds them in the portfolio. So this is really, really interesting because in the last 2 to 3 months, we have seen what happened with the market. While the whole market was going down the drain, this fund was performing relatively very, very good. I mean, think about it. In the market conditions like we have, if this fund generated 7.44%, this is an amazing return, right? I mean, you would agree with that. Now let's take a look at this chart right here. So BTAL is the sign for this particular fund. So since 2000, you can see 27.95 was the highest and 16.15 was the lowest. 16.15 was the lowest in November when the markets were doing really good. When the market started to come down, look what happened with this fund. This started to go up because remember, this was shorting the high beta stocks. High beta stocks were doing relatively well, and that's why this fund was not. So this is a really interesting ETF in my opinion, because as you can see, the March crash that we had when everything crashed down of 2020, this ETF actually touched its highest. And then after that, when we had that big run up, when everything was going up, and then after that, it has been on a decline. Now, since November, of course, after I would say it started December, we have seen this ETF gain traction. Right now, it's about $18, $19, which is of course a very good entry. If you look at going back to 2020, it's almost down from $27 or $28, which is $27.95 to about $18.93. So this is really interesting of an ETF because it's tracking both. And it's making you money in any market conditions. Now, I wouldn't put my money in for, let's say, 2 years or 3 years. This is an ETF where you want to come in and out depending on the market conditions. Now, we know that today was a very good green day. But are we done? Are we out of the water yet? I don't think so. I think we are going to see more volatile day ahead of us. When we had the Fed come out and announce the interest rate, in my opinion, we are going to see 4 to 5 interest rate hike. That means 0.25 interest rate for every meeting. Now, if they come out in March and give us a 0.50 hike in the interest rate, that counts for two rate hikes, but now it's added into one. So some of them are saying it's not possible for Fed to come out and give us like 5-6 hikes, but they can come out and easily give us 0.50 interest rate hike for the very first time, and that'll count as 2, because before they were talking about 0.25. So in these market conditions, this kind of ETF makes sense. So the question is, will I put my money in this ETF? Well, from what I'm seeing and reading, I feel cautiously optimistic, and I will invest a bit and see how the fund trades and what kind of return I get. I will invest with a stop loss for sure, because I'm done with these market swings and don't have appetite for any more risk. Let me know your thoughts about this fund, and also how are you hedging in these times? I hope this was helpful, and if you liked the video, then consider subscribing and hit the like button. And for more one-on-one conversation, consider joining our Discord and Patreon. Links are in the description. Pleasure to share all of this with you. Until next time, you all have a sparkling day.